What's up everyone, it's Jan here. Today we're tackling a big one, how to value a startup. If you're thinking about investing in a startup, or even starting your own, understanding valuation is crucial. Unlike established companies, startups are young, scrappy, and often unpredictable. So forget about those traditional valuation methods. We need a different approach, and that's what I'm going to show you today. Valuing a startup is like trying to predict the weather 6 months out. It's tough. Startups don't have the luxury of years of predictable cash flow or stable earnings. Instead of relying on historical data, we need to get a little creative. We're talking about assessing their growth potential, the size of their target market, and the level of risk involved. Think of it like this. You're investing in the potential, not the present, and that potential comes with a whole lot of uncertainty. When it comes to putting a number on that potential, we have a few different methods. Some common ones are the venture capital method, the discounted cash flow, DCF method, comparable company analysis, and the Berkus method. Each method has its own strengths and weaknesses, and the best one for you will depend on the specific startup you're looking at. Let's keep things simple and focus on the venture capital method. How does the venture capital method work? It boils down to two main steps. First, we estimate the startup's terminal value, which is the company's estimated value at the time of exit. An exit could be an IPO or an acquisition. The second step is to discount that terminal value back to today's dollars using a discount rate. This rate accounts for the high risk associated with startups. After all, not every startup becomes the next Google or Amazon. Let's make this real with an example. Say we're looking at a hot new tech startup developing AI-powered software. They're projecting revenue of $50 million in 5 years. Similar companies in the industry are trading at 5 times their revenue. So we multiply the projected revenue by that multiple, giving us a terminal value of $250 million. Remember how we talked about startups being risky? It's time to factor that risk into our valuation. Investors typically use a high discount rate for startups, often around 40%. We'll use a simple formula: present value equals terminal value divided by 1 plus the discount rate, raised to the power of the number of years. In our case, that's 250 million divided by 1.4, raised to the power of 5. When we crunch those numbers, we get a present value of approximately $46.5 million. Hold on, we're not quite done yet. We need to factor in the investor's desired rate of return. Let's say our investor wants a healthy 25% return on their investment. We also need to account for ownership dilution, which happens when a startup raises additional funding in future rounds. This can decrease the ownership percentage of early investors. To adjust for these factors, we'll need to lower the valuation accordingly. This means recalculating the investor's stake and figuring out how much ownership they would need to achieve their desired return. Valuing a startup is a complex process. It's a mix of quantitative analysis and qualitative judgment. It's about looking beyond the numbers and really understanding the business, the team, and their vision for the future. Do your research, trust your gut, and don't be afraid to ask tough questions. And there you have it, my friends. That's a quick rundown on how to value a startup. Whether you're an entrepreneur or an investor, understanding these valuation methods is crucial for making smart decisions. Every startup is unique, and you'll need to tailor your approach accordingly. Did you find this example helpful? Let me know in the comments below. And don't forget to subscribe for more finance tips and tricks. Until next time.